Have you ever wondered what would happen if you invested $10,000 in just one ETF? Well, today we're diving into the world of the QQQ ETF to find out, turning that $10,000 into a small fortune by making a small investment. Sounds exciting, right? Now, you might be asking yourself, why QQQ? What makes this particular ETF a top contender for long-term investment? In this video, I'm going to break it all down for you. From its historical performance to potential future growth, and even some of the risks involved, we got you covered. Stick around till the end to see our projections on how much your investment could grow over the next 10, 20, and 30 years. Spoiler alert, it has the potential to cross $1 million valuation by the time you retire. Alright, let's start by understanding what QQQ was all about. But first, what is an ETF, or Exchange Traded Fund? It is like a mix between a stock and a mutual fund. It's traded on stock exchanges just like individual stocks, but it holds a collection of assets similar to a mutual fund. Think of it as a diversified portfolio packaged into one convenient investment. The beauty of an ETF is that it allows you to invest in multiple companies at once, reducing the risk compared to buying individual stocks. And one such ETF is the QQQ. The Invesco QQQ Trust, commonly known as QQQ, is an exchange-traded fund that tracks the NASDAQ 100 index. This index includes 100 of the largest non-financial companies listed on the NASDAQ stock exchange. Essentially, when you invest in QQQ, you're getting a slice of some of the biggest and most innovative companies in the world. One key thing to note about the QQQ is that it's passively managed. Instead, it simply aims to replicate the performance of its underlying index, the NASDAQ 100. This passive approach helps keep fees low, which is great news for investors like us. But this doesn't mean it lacks big names when it comes to its holdings. The ETF is heavily weighted towards tech giants, which play a significant role in its performance. Here are a few of the major players. It includes Apple, a leading innovator with products like iPhones and Macs, making up a substantial portion of QQQ. Microsoft, known for its software and cloud computing ventures, which contribute to its consistent growth. Amazon revolutionized e-commerce and cloud computing with AWS. Nvidia leads in graphics processing technology, essential for gaming and AI. Meta Platforms, formerly Facebook, is a social media powerhouse generating substantial ad revenue. Alphabet, Google's parent company, dominates online search and digital advertising. These companies highlight QQQ's focus on innovation and growth, making it a compelling investment. These companies represent just a snapshot of QQQ's holdings, but they highlight the ETF's focus on innovation and growth. By investing in QQQ, you're essentially betting on the continued success and expansion of these leading firms. Let's take a closer look at how QQQ has performed historically. This will give us a better understanding of its potential for future growth. Over the past decade, QQQ has delivered impressive returns. On average, it has achieved an annual return of about 17%. This is significantly higher than the average return of the broader market indices like the S&P 500, which has averaged around 10% annually over the same period. This outperformance is largely due to the strong growth of the tech sector, which makes up a substantial portion of QQQ's holdings. To illustrate this, let's consider some real-world examples. If you had invested $10,000 in QQQ 10 years ago, your investment would be worth approximately $47,000 today. That's nearly 5 times your original investment. This kind of growth is why many investors are drawn to QQQ. But it's not just the past decade where QQQ has shown. Since its inception in 1999, QQQ has consistently outperformed many other ETFs and indices. Despite facing some tough market conditions, as the dot-com bubble burst in the early 2000s and the financial crisis in 2008, QQQ has shown resilience and a strong recovery each time. One of the reasons for this strong performance is the quality of the companies within the ETF. Companies like Apple, Microsoft, and Amazon have shown remarkable growth and innovation, driving the overall performance of QQQ. Their ability to adapt to changing market conditions and continue to grow has been a significant factor in QQQ's success. Now that we have a good understanding of what QQQ is and its top holdings, let's talk about its current valuation. When we look at the current valuation of QQQ, it's important to understand how it's priced in the market. Right now, the QQQ ETF is trading at a higher price-to-earnings ratio compared to many other ETFs and indices. The P/E ratio is a common metric used to value stocks, indicating how much investors are willing to pay for each dollar of earnings. For QQQ, this ratio is elevated due to its heavy concentration in high-growth tech stocks. Historically, tech stocks have commanded higher valuations because of their growth potential. Companies like Apple, Microsoft, and Amazon have consistently delivered strong earnings growth, which justifies their higher P/E ratios. However, this also means that QQQ can be more expensive compared to broader market indices like the S&P 500. To put this into perspective, let's compare the P/E ratios. As of the latest data, the P/E ratio for QQQ is around 30, whereas the S&P 500 is closer to 25. This difference highlights the market's higher expectations for the tech-heavy QQQ. But what does this mean for investors? Investing in QQQ at higher valuations can be risky. However, it's not all bad news. The high valuation of QQQ reflects the market's confidence in the continued growth and innovation of its top holdings. Companies within QQQ have strong business models, robust revenue streams, and a track record of success. This makes QQQ a compelling investment for those who believe in the long-term potential of the tech sector. In the end, I will show you how this ETF has the potential to turn a $10,000 investment into over a $1 million retirement valuation. One way for you to mitigate the risk of investing at high valuations is to adopt a dollar-cost averaging strategy. This involves spreading your investment over time and buying shares at different price points to average out the cost. This can help reduce the impact of market volatility and lower the risk of investing a large sum at an inopportune time. Investing in the QQQ ETF offers many benefits, but it's crucial to be aware of the potential risks involved. First, market volatility is a significant risk. The QQQ ETF is heavily weighted towards tech stocks, known for their high volatility. Prices can fluctuate significantly in a short period, leading to substantial gains or significant losses, especially during market downturns like the tech bubble burst in the early 2000s. Technological disruption is both a growth driver and a risk. New technologies can disrupt existing business models, and companies that fail to adapt may see declines. Next, valuation concerns are important. As we discussed earlier, QQQ is currently trading at a higher price-to-earnings ratio compared to other indices. This elevated valuation can be a double-edged sword. On one hand, it reflects the company's confidence in the growth potential of the companies within QQQ. On the other hand, it also means that if these companies fail to meet market expectations, their stock prices could fall sharply, leading to potential losses for investors. It's essential to be cautious about investing at high valuations and to consider the potential for market corrections. Hence, the reason to go for a dollar-cost averaging strategy. Despite this, the future growth of the QQQ ETF looks promising, driven by advancements in technology, digital transformation, and emerging markets. The ETF benefits from investments in areas like AI, cloud computing, and biotechnology, positioning it well for future growth. The rise of emerging markets and increased consumer spending further enhance its prospects. Digital solutions adoption across industries support its growth trajectory. Analysts predict strong revenue and earnings growth for its top holdings. Alright, let's get into the numbers and calculate the potential returns on a $10,000 investment in the QQQ ETF. This is where things get exciting. First, we'll look at the current dividend yield. QQQ has a modest dividend yield of around 0.59%. While this isn't a huge source of income, it does come with a dividend growth rate of 10.75%. It's a nice bonus on top of any price appreciation. Dividends can be reinvested to buy more shares, compounding your returns over time. Next, we'll consider the historical share price appreciation. Over the past decade, QQQ has averaged an impressive annual return of about 17.35%. While past performance doesn't guarantee future results, it gives us a solid foundation to project future returns. Here's the breakdown. Starting with an investment of $10,000, here's what you could expect. After 1 year, your investment would grow to approximately $11,793. In 10 years, the investment could reach around $51,390. After 20 years, your initial $10,000 might grow to an astounding $259,311. Finally, in 30 years, the investment could skyrocket to about $1,296,417. The total value added to your portfolio after 30 years would be $1,286,417, with capital appreciation contributing $1,277,072, and dividend reinvestment adding another $9,344. Want to know how to turn a one-time $25,000 investment into over $10 million that pays $10,000 every month? Click the video on the screen to find out.